Hey, and welcome to CT Guides. I'm your host, Theo, also known as Tao Cruz, and today we'll be doing a lesson on moving averages and trading strategies. We'll start with theory for your basic understanding, and then supplement with chart examples so you know how to implement these strategies in your own trading. Now, the purpose of moving averages is to smooth out price data by creating a line of average price over a specific number of days. And there's two types, being the simple moving average and the exponential moving average, which I'm going to talk about in the following slides. And the moving average can be applied to various time frames. You can do it on the short term, being like 10-day, medium term, more like 50 days, and then also long term would be like 200 days or more. In terms of identifying trends, the 50, 100, and 200 day moving averages are commonly used as dynamic levels of support and resistance. Dynamic meaning they change daily based on each new closing price. And as a rule, the longer dated the moving average is, the more significant the support or resistance level is. So I have Bitcoin up here on the daily chart, and I'm going to explain what I mean by dynamic support and resistance. Also, these lines here, the yellow one is the 50-day SMA, this red one is the 100-day SMA, and then this purple one is the 200 SMA, meaning the simple moving average. Now, you can see right here this 100-day SMA is kind of acting as our support right here. We're maybe kind of going under it, but generally speaking, it's kind of acting as a guide and kind of acts as support for us. This yellow line, on the other hand, with the 50-day SMA, that's acting as resistance, and you can kind of see that every time we kind of get near that, we're rejecting, and then back up here, we reject once again. And then this purple line, I would say for the bulls, we definitely don't want to go down there. That would be like critical support. And if I zoom out right here, you can kind of see if we were to kind of drop down here, that would kind of line up with this pocket of support right here. So it would make sense that 200 SMA would be critical support for us. There's two types of moving averages. The first one we're going to talk about is the simple moving average. And the way that's calculated is by adding up the closing prices of a token over a specified number of days and then dividing by that number of days. So, for example, the 50-day SMA is the sum of the closing prices of the last 50 days divided by 50. And the key point to note here is that all the closing prices in the time period all have the same weight. Two popular trading patterns that use the simple moving averages include the death cross and the golden cross. So the golden cross occurs when the 50-day SMA breaks above the 200 SMA. And that's reinforced by high trading volumes and can signal further gains are in store. On the other hand, the death cross occurs when the 50-day SMA crosses below the 200 SMA, and that's considered a bearish signal, indicating that further losses may be in store. So I'm illustrating a golden cross here, with the yellow line being the 50-day SMA, and then the purple line being the 200. And you can see back here in November, a golden cross was made when that 50-day crossed above the 200-day right here. And that was in November of 2023. And as you can see, that really kicked off the major bull run where we're currently in right now. Now for the death cross, we're going to kick it back here to January of 2022. And as you can see, the 50-day SMA line crosses beneath the 200-day SMA, and that leads us into a major downtrend, to lows down here, where eventually, we made a golden cross right here, like I just spoke about, and that led to another bull rally right here where we made new all-time highs. The second type of moving average is the exponential moving average, And it's a more complex calculation that gives greater weight to more recent prices. Therefore, it's going to react faster to price changes compared to the simple moving average. So using EMA as an indicator, conditions are bullish when the 20-day EMA crosses over the 50-day or remains above the 50-day EMA. And conditions will turn bearish if the 20-day EMA falls beneath the 50-day EMA and then stays beneath it. So for the bullish EMA trend, you can see back here in October 2023 that the 20-day EMA rises above the 50-day EMA, and then it stays there for quite some time until just recently, which would be right here at the end of April. That the 20-day EMA then falls beneath the 50-day line, and that's going to be signaling bearish conditions. So moving average crossover divergence, also known as MACD, is based on the relationship between the short and long-term exponential moving average, and it's useful because it brings together momentum and trend in one indicator. So a MACD crossover can occur in two scenarios. The first being when a shorter-term EMA crosses above a longer-term EMA, and that generates a buy signal. And the second scenario is when the shorter-term EMA crosses below a longer-term EMA, and that generates a sell signal. And that crossover is perfectly encapsulated right here. As you can see, the red line being the 20-day EMA crosses through the orange line being the 50-day EMA. And that's going to show that that's a buy signal right there, and it sure is as we go and make all-time highs. And then right kind of here, perhaps the rally might be fizzling out. We see the shorter-term EMA cross back under the longer-term EMA, and perhaps there might be new lows in store. Divergence occurs when the MACD line diverges from the price movements of the underlying token. So bullish divergence happens when the price makes a lower low, but the MACD makes a higher low, suggesting that there's going to be a bullish reversal. On the other hand, a bearish divergence occurs when the price makes a higher high, but the MACD makes a lower high, suggesting a potential bearish reversal. So right here on the bottom of the chart, I have the MACD line, which is this blue line right here. And so for a bullish divergence, you can see we're going back here to January 2023, kind of the start of the bull trend. We come up here, it looks like things are going good, but then we make a lower low right here. And that coincides with MACD. Because here on the MACD chart, we're making a higher low. As you can see, there's a low back here, beginning of the kind of like the bottom of the chart, and then right here is where we make that higher low, and that really tells us that's a bullish signal we should buy. And as you can see on the chart, the buying cranks up right here and just continues to accelerate. Now I'm going to illustrate the bearish divergence in MACD. So that's going to happen when the price makes a higher high and then the MACD makes a lower high. And as you can see on the chart right here, we do make that higher high kind of here on April 8th. Kind of going back here, we reach all-time highs, cool off a bit, make a lower high right here. Oh, but then we make a higher low, so it looks like things are potentially reversing. We could go to the above all-time highs, but then we get there to that higher high, and you look down here at the MACD chart, you can see that we're making a lower high, right? Lower high on the MACD plus the higher high on the chart. That's going to be our divergence right there. Now, a MACD histogram is used to identify overbought and oversold conditions. So a positive histogram indicating bullish momentum, while a negative histogram would indicate bearish momentum. And extreme values may suggest potential for a trend reversal, as momentum is likely to slow after achieving that extreme. I have my histogram here at the bottom of the chart. The red obviously indicating negative momentum selling, and the green positive momentum being buying. The extremes, I want to show this, like right here. Look back here around May of 2021. The selling hits an all-time extreme right here. We kind of slowly move ourselves down a little bit more, but all in all, it's a good place to start, getting some long orders in, because look, we reverse and we make an all-time high right up here. Now, we can kind of relate that to where we are right now in the current day for Bitcoin. Although it's kind of happening a little bit in reverse. We can see right here, we hit the extreme for the buying right here at the all-time highs. And then we reverse, complete 180 and hit the selling hard. I mean, there's a lot of profit taking there, obviously, and we've kind of slowly kept on moving our way down here, but at the same time, that selling is getting lower and lower, right? That was kind of that extreme moment, and we're moving ourselves lower, but it looks like there might be a little bit of a light at the end of the tunnel here, and that there could be some potential upside, because as that selling volume falls lower, buyers are going to step in, and perhaps there's that 180 switch and the buying volume starts up, and as does the uptrend, and we can break out of this kind of downtrend we've seen since we've hit those all-time highs. Well, that marks the end of today's video, guys. I hope you enjoyed it, and if you did, please leave a like on the video. And if you have any questions about what we talked about today, like the topics or the indicators used in TradingView, feel free to leave a comment below, and I'll get back to you as soon as I can. We'll see you on the next one. Take care.